So a question was asked about from, I think, David Rose in relation to our views on rising interest rates and how it impacts the business. And we saw a subsequent comment from him to say that he doesn't believe the question was fully addressed. We're not sure in what way, but I'll give a very comprehensive further response to what Rahman would have outlined. And hopefully at the end of it, I would have answered whatever lingering concern Mr. Rose has, and perhaps the entire shareholding will learn a bit more about our investment views and how our business has been structured. I'm going to first take it from a macro basis. The current interest rate tightening cycle, which is happening globally, including Jamaica, is a result of inflation fears, and central banks, both locally and globally, have been tightening interest rates, increasing interest rates, and tightening liquidity. And we believe that at the end of the day, except for some evidence of labor market tightness in the US, the demand curve in most economies, both developed and developing, including Jamaica, are not reflecting strong demand conditions to withstand the kind of central bank actions we have seen. And so we believe that over the next few months, it is more likely than not that most central banks around the world, including our central bank here in Jamaica, will attenuate their level of interest rate increases, or perhaps put a pause on interest rate increases altogether. And so, I'm just summarizing at a broad level what our view is on interest rates, the interest rate cycle globally and locally. We believe we're getting close to the top of that tightening cycle by central banks, and it's based on our view of the overall strength of demand, aggregate demand globally, including here in Jamaica. Now, interest rate tightening has two primary effects on securities dealers, and here we come to the repo rate specifically. First, it means that securities dealers whose liabilities tend to be repriced every 30 to 90 days will have some level of net interest margin tightening, which has a reducing effect on net interest income. And secondly, it means that to the extent a dealer is invested in risky assets, risky fixed income assets, and when I say risky fixed income assets, I'm talking at just about any asset that's not equivalent to a AAA asset that would be exposed to widening of credit risks and increasing benchmark rates. You'll find that the dealer is exposed to adverse changes in fair value positions and those securities, resulting in fair value losses. So what's the impact of that on Barita? Starting with the rising repo rates, as Rahman mentioned, if you look at the evolution of Barita over the last 3 years, we have taken a deliberate set of actions to reduce the reliance of our business on net interest income. And so yes, repo rates rising will have the effect, all of the things being equal, on reducing net interest income. But the impact on Barita's overall revenues and profits is not something that gives us cause for concern. And that's because we have deliberately diversified our business away from reliance on net interest income. Rahman gave the statistics 3 years ago. Net interest income accounted for roughly a third of Barita's net revenues. We're on the way to taking that below 20% of overall net revenues. How did we do that? When I joined back in 2018, we sat as a team together with the CEO, and we looked at what was happening in the world. And what we saw was that starting from the recovery from the subprime crisis in 08, 09, asset prices have been on just a run up, almost uninterrupted run up, with probably the temporary exception of the European crisis, which occurred somewhere between 2013, 14, thereabouts. But if you look beyond that, it was a steep curve, and we decided that there was not much value in continuing to buy government bonds. We decided deliberately that we're going to be measured in the amount of capital we allocate to government bonds. And so we made a deliberate decision to allocate capital significantly in low beta exposures that we expect to generate alpha for us in tough environments like the one that we are now in. So quite frankly, the business of Burita is built for conditions like this. Burita, and it's not just with respect to revenue diversification, it's also with respect to the fact that when the rest of the world, coming out of that subprime crisis under the direction of their regulators, were serially building up their capital bases to ensure that come the next leg down, which is what we are now seeing, they're in great position to withstand severe shocks. Burita and the Cornerstone Group was doing the same. With Cornerstone did the same for its bank, Cornerstone Trust and Merchant Bank, which boasts the highest capital adequacy ratio across the banking sector. Burita is the same. Burita boasts the highest capital adequacy ratio across the securities dealing space, with that ratio being up north of 46%. Based on our last measure, and as at September 2021 at 52%. That is above the regulatory minimum of 10%, and the average based on the latest data we saw from the FSC with respect to securities dealer average of 22% sometime last year. So our statistics are twice in terms of capital adequacy what obtains in the average for the average securities dealing capital adequacy ratio. So both from the perspective of the impact of rising interest rates on our net revenues because of the diversification we have done, and I'll speak a little bit more about that, and also because of the formidable capital base we have built over the last 3 years, Burita is well positioned to withstand very severe shocks that we have already seen in the global market, and severe shocks to come. So we're very comfortable that we're well positioned from that perspective. Now, on the net revenue front, we said that, okay, we're not going to sink our money in expensive high beta assets that are going to be susceptible to price declines in an environment like now, resulting in heavy fair value losses. What have we done with the funds? Well, we have seeded alternative investment strategies, and that's where MGR real estate investments come in. Over the last 15 months or so, Burita, through its seeding of these off-book real estate holdings, has moved its capital exposure, indirect capital exposure, to real estate from 0%, just above 0%, not anything of significant note, towards 25% of capital. Those investments are hardy assets in inflation environments with heightened inflation, heightened interest rates. And so those assets which we were able to buy in the middle of the crisis at favorable valuations have done well consistently throughout, while traditional assets have been falling in value. Burita has an investment management agreement with our off-book real estate holding vehicle. And through that investment management contract, Burita earns management fees, which are divided into fixed fees and performance-related fees. And you see the benefit of the revaluation of those assets flowing through to the P&L of Burita. So Burita is in a position, based on its investments, to perform very well in this environment. But we have not only invested in real estate, we have also, over the last 18 months or so, moved our exposure in private equity and energy from around about 0% to about 10% of capital. And those warrants we have purchased with respect to those exposures, private equity, including energy-related assets, would have supplemented whatever lost revenue opportunities that the current environment presents for traditional assets. And because of that, that's why you're seeing the robust performance of Barita, even in what we believe are challenging circumstances globally with supply chain disruptions, inflation fears, and the war in Europe, which is now bringing to the fore food and energy security concerns. So we just wanted to give a very comprehensive view of how we see the interest rate environment and why we believe that Barita is positioned very well to perform, to continue to perform robustly despite those headwinds. Many persons see Barita's marketing and advertising, see our performance, and talk about how slick it looks, how aggressive we are with respect to our performance. But at the end of the day, you need to look at our key ratios, look at the strength of our balance sheet. If you look at that, we're market leading as it relates to our robust capital and our liquidity. And I can't speak too little about our liquidity because it positions us to take advantage of the current environment. So the forward-looking, position from my perspective is very positive for Barita, even if the tough environment continues. I hope that provides a full answer to Mr. David Rose, but also gives the shareholders a better understanding of our business and how we have deliberately allocated capital to make sure that we protect your interests, whatever storms may come to the capital markets. And we're an open book. So as Chairman said, we didn't want to leave here and anybody believes that we didn't fully answer any question posed. So thank you.